Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me at the desk on the Nasdaq Market site, we have Chris Dearborn and Maddie Radner, both on the Nasdaq Market Intelligence Desk, as well as Dr. Preston Cherry with Concurrent Financial. We are here to discuss the emerging trends that we're seeing in early 2025 that could shape the capital markets in 2025. It is great to have all of you with us. Welcome back to Trade Talks. And Preston, you know, the market performance in 2024 was quite remarkable. And the question is, can this momentum continue? There are a number of variables. So when you're thinking about it from the perspective of financial planning, how are your clients approaching it? How are you, keeping them off the ledge and thinking about their longer term investments?
Well, I think you used a great word, which is momentum. And if we were to concentrate on fundamentals in the stock market, I think folks would not have much direction. Everything is overvalued. It's kind of like overcooked food, right? But everything is overvalued, so where do you go? And this is where we see a default to, hey, well, let's go, instead of stimulating the economy with the Fed interest rate cuts, into sustaining and just kind of steady as you go, because a lot of momentum and sentiment is in the markets right now, but also that's highly emotional also. So I think folks just need to continue to maintain what they're doing, because there's really no strong signal of where, what we're, as far as direction is concerned.
And it's interesting, Preston, because your doctorate work is in personal financial planning, and I would imagine a lot of behavioral finance falls into that as well. And I think because there was so much liquidity in the system and we got into this mentality of buying the dip, investors aren't used to the ebbs and flows that give you that average 8% return. I mean, look at the double-digit returns across all indexes last year, right? It's supposed to go up and down at the end of the day.
It is. Again, we're back to fundamentals. I mean, so I have a conversation with my clients all the time, is about these fundamentals, not to overly emotional react. Let's talk about how we can stay on course and do what you're continuing to doing. If we look at a lot of numbers, I'm sure we're going to talk about a lot of numbers here today, but where people are still not really feeling the wage increases in their pocket. They're still trying to catch up from inflationary numbers that seem to be cooling, but they're still high pre-COVID.
Well, that's how people are benching it. It doesn't matter year over year. They're thinking about what it looked like in 2019 and 2020. And Chris, on the desk, you cover consumer companies. It's been hard to bet against the consumer.
Consumers, well, let's take a step back. It's hard to bet against large cap stocks across the board that are widely held. And a lot of them are consumer names. You take a name like Costco, even Amazon, which is a multifaceted business, but definitely in the consumer space, you look at a company like Netflix, even Tesla recently, right? So the gains have come for a number of those stocks in fits and bunches, right? The Mag 7 has definitely had a great run. A lot of the other ones have come across. Tesla was wallowing for a long time until the election race kind of kicked off, and then really a vote of confidence in Elon Musk and the stock itself, and the company is doing very well. When you look at under the hood a little bit, you look at the mid-cap and small-cap names, there's a different story. A lot of the restaurants are suffering. So there are the haves and the have-not, same with the retail space, and same with the consumer staples space as well. There's a lot of haves and have-not that are doing very, very well. You look at the government, when they do intercede in things, if you look at the Albertsons-Kroger deal, it really was a problem with the creation of wealth for a number of folks who own those stocks, and then the deal fell apart. So when you look under the hood, it's definitely the retail names that that are doing very, very well. And a lot of the companies that you don't know, they're regionally based, are doing better, but not great. But the small cap names is where the suffering is. And that's where the pain has been. And a lot of the companies listed here are small cap names that aren't really performing to the magnitude of the S&P 500. And then to take into that effect, we'll switch a little bit to here. You look at the hawkish Fed commentary that we've got in the last couple of weeks, and that has really put a dinger into the small cap trajectory. The Russell 2000 and 3000, the S&P small cap index, as well as any of the other small cap stocks that you're following, have had a very hard time since December peak and are really having a rough start to this year.
Yeah, Chris, last September, when there were about 4 rate cuts anticipated for 2025, is when we started to see those small caps rally. Then heading into the election, rally continued. But then in December, as rate cuts kind of narrowed down to only about 2, is when they started to come off that rally. And the Russell 2000 is now about 10% off of that kind of post-election peak. So we are seeing them struggle a little bit here as we head into 2025.
A stronger economy is what we're having right now, a lot more thought than the Fed thought. And since the SEP plot got readjusted, we're only looking at 1, maybe 2 cuts, probably 35% basis point cut in total by the end of the year. You've got a 50% chance of the first rate cut really coming maybe June, and then maybe one more by year end right now, depending on which broker you talk to. Granted, there's a lot of more economic data to come forward. We get CPI tomorrow. PPI today was definitely in the wheelhouse a little bit, but the non-farm payroll number last week was extremely strong. And it's showing you, to your point earlier, Preston, you're talking about wage growth. It did show wage growth, but not as much. It did show more jobs being created, and the unemployment number did tick down, albeit it's a larger group of folks that are participants this last month than the previous month. So it's a good thing, but really, if you look at inflation since 2020 through now, things cost 25% more. Usually that's a generational gap, not a 4-year gap, especially if you're us.
But that's the whole thing. The trends are just moving. It would take like months or years or quarters for these trends to play out, and they're in recession sometimes.
Yeah, I think that the Fed and a lot of what's going on in the market is saying we need to stabilize, the economy, not necessarily strengthen it, because the numbers are good, but good for how long and to whom? Right now, savings has shrunk a little bit. I think it was a high during right after COVID, like $2.5 trillion in people's savings accounts. Right now, we're hovering around 500 billion, something to this effect. So, income challenged folks, they've exhausted their savings, and folks that have, the wealthy, they've got money in their pocket, they're saying, hey, let me take a step back a little bit and see if this stable economy is going to continue. So they're taking money off of the shelf a little bit.
Yeah, and when you think about it through the financial literacy and planning perspective as well, that kind of is a microcosm of what we see in general. The disparity in wealth and closing that wealth gap and managing money in a way where it's more sustainable and having savings and being prepared. I mean, we cover this all the time. It almost feels like this scenario is a microcosm of what we're seeing in the broader financial planning and literacy landscape.
Yeah, absolutely. And then when you're talking about getting prepared for the next 6, 9, 12 months, this is what we're talking about, the linkage between savings roles, all right? That now folks don't have that wiggle room. And quiet as kept, I think we could be positioned for a headwind. I mean, this is where you're not, you mean the Fed, they're not stimulating the economy with all these rates cuts. You said 4, Maddie, like you said, coming down to 2, it's stabilizing. But what if a headwind comes in? What's next? And so this is where I think people are watching their pockets a little bit, and not going in, spending a lot of stuff in consumer staples a lot. Those stocks are struggling a little bit. Even when you talk about the hope factor, folks are either buying their first home or they're moving to their second home. Rates are still high. And at the end of the day, housing controls the market a little bit, because now can you buy a house or move to your next one and then put stuff in it?
Right. Well, that's the whole thing too. Just because you could afford a $1 million home doesn't mean that you could afford the utilities and everything else that goes along with it. But I think you make a great point in between the lines here. The economy and the market are two very different things, because some surveys that we saw last year, there was this perception that the market and the economy aren't doing well. So while your 401k or your other investments might be doing well, what you see day to day in the economy feels or tells an individual investor a different story. And that's an important distinction to make.
It very much is. I mean, right now people are confident in the jobs they do have. I mean, the job creation is not busters, it's not busting out of the seams, but people are not losing their jobs either.
Right. It's also a shift of skill sets too.
Yes, about the skill sets. I mean, so right now there's a lot of things that are still inflationary. Child care is through the roof right now, and that affects all income, socioeconomic statuses, right? Insurance, we're seeing the unfortunate events happen in the wildfires, but all types of insurances have been increasing a lot.
Well before the
You
fires.
have no choice, Chris. You need child care, you need insurance.
Right, that's what eats into it. And then rent is finally starting to come down, and that's generally a 2 to 3 year runway. So that's starting to come down a little bit. But if you look at the numbers, say the PPI was talking about, energy being ticked up, which makes sense because we've had a significant cold spell recently over the entire U.S. from Montana all the way up, not Montana, Missouri all the way up to here, D.C., New York, and everything else. So people are spending a little bit more there. Gas is relatively still cheap. The price of a gallon of gas is still relatively about $3, which is relatively inexpensive. The inflationary problem is what the Fed is focused on right now. Even though they said they switched to labor, and they did, right? So I don't know what's going to happen. We've got the meeting at the end of January. They're going to probably not cut rates, right? And then we got to wait till March. We get a lot of information in between that. The new administration's coming in. Tariffs, if they do get enacted the way the media is talking about, and some of the headlines will be very inflationary. But there's headlines again today that said it's going to be gradual, 2 to 5% on a month-over-month basis. Yeah. So I'm not really sure where it is. Is it a negotiating tactic down the road, or is it something actionable? We have to wait and see. That wall of worry is a big item, and that's why you're seeing the 10-year at 4.8%.
Well, the markets are always climbing some wall of worry. Right. At any given day.
That's what investing is.
Well, of course. Well, Maddie, let's get back to the capital markets for a moment here. In your small caps, of course, the JP Morgan 2025 conference is going on. And as I'm looking through the headlines today, it's AI, how NVIDIA technology, Illumina technology is being leveraged. It's almost like they're going back to those large caps at this conference, which is typically known for the news that these smaller cap companies deliver. They seem to also be more positive on what the M&A environment is going to look like for 2025. Anything you can tell us from the small cap space, healthcare trends, what you think the capital markets are going to look like?
Yeah, I think just in general, investors are really gearing up for a pickup in M&A and deal-making activity in 2025. Yesterday was day one of the JP Morgan Healthcare Conference. It really hit the ground running with $18 billion in biopharma M&A deals announced, including the largest deal since March of 2023. We're seeing a lot of billion-dollar deals announced, so more in the larger cap space, as Jill noted. But healthcare M&A volumes actually dropped by half in 2024 from 2021. So now that inflation is a bit under control, interest rates are hopefully continuing to decline, we'll see more deals come into play. And we are seeing pretty strong investor reaction to the pre-announcements taking place and the corporate updates taking place, both in a positive and negative way. There's definitely increased scrutiny over some of the companies that are missing slightly on revenue, or their corporate update isn't as positive as investors would like. So all eyes are really on this conference this week.
Right, but think about it also back to the M&A conversation. Let's look at some of the headlines. Tempest AI unveils new Gen AI capabilities. NVIDIA partners with Mayo. Illumina for AI agents. Health Catalyst picks up patient engagement solutions provider, upfront healthcare services. So you're seeing, rather than organically grow these emerging AI capabilities, they're acquiring, right? So whether it's the primary, secondary, private markets, and so forth, I think that's kind of where the trend is going to be.
Yeah.
Don't reinvent the wheel and organically grow this technology. There are a number of providers out there that are small and nimble that you can integrate into your larger platform.
A lot of these companies are running out of cash, so they either need to merge with a company or raise more capital, and right now it looks like M&A is the way to go for them.
I mean, Preston, it makes you wonder if we did not, AI is not anything new, let's call it 10, 15 years that it's been around on a higher level, but with generative AI becoming part of the vernacular in November 2022, consumers, enterprise integrating it into minute-to-minute processes, what if that story did not exist? Right? When you think about efficiencies, when you think about the move in the market and different skill sets for different jobs, what if that wasn't part of it? Our conversation would look very different.
It did. Well, here's the thing, jobs again. Here we are back. Let's take it back to really fundamentals, right? Maddie, I like your talk about cost of capital. What is it going to be for businesses in order to reinvest into these areas, these growth areas? If we have a strong signal about what the cost of capital is, then we can see money being redeployed into these great ideas. Here, let's go back to jobs. Is it generative AI being this big disruptor? We haven't seen it quite yet. I think we still need human beings around. So jobs are pretty steady. Are we going to get a signal about cost of capital? All right. All of these type of different areas is like we need a trend in these areas. Right now it's very new. We don't have any trends. This is why I'm saying about stability and sustainability right now for, I would say, 9 to 12 to 18 months to see if are we in our normal period now? Is this how we're going to work as far as cost of capital, rates, and the economy in all these areas? And if this is our normal, then we can operate.
I think you have something to say. I can hear you next to me.
No, you can hear me next to me. Ideally, it's going to be led on the macro level across the board. AI was the driver of the market move last year for the most part, right? And then finally, when the inflation started to come into the 2% rate, what the Fed was looking for, they did 4 cuts in 3 months, right? However, rates rose into that cut. So the question then comes down, is the Fed really behind the curve or not? And is the labor market really strong enough to weather this storm that we have here? Even though the markets look good, home prices are up, people who have a little bit more, but the people on the bottom end, you go to their savings point before, that was mostly from the COVID checks. That ran out after 2.5, 3 years.
I'm surprised it lasted as long as it did.
You know, yeah, me too.
Yeah.
But it did last a lot longer than most people who were in the markets thought, but the economists disagree. They say it lasted as long as it should have. The question then comes down, what's going to keep this up? You know, if you're making $22 at Walmart in California, is that enough to sustain your living expenses if you're a family of 3 or 4? Probably not. So I don't know what's going to break here, but something has to give and change, whether the market can keep moving on the AI platform and then expanding it. If interest rates start to come in, inflation does start to come down, that could be a very good thing. On the flip side of it, with the new administration, if the tariffs play out the way they say on TV, things are going to be a little bit rough, but if it's really just a negotiating tactic, things could be pretty good. I mean, earnings for Q4, we're looking at over 11% growth. That's a 3-year high. That's phenomenal. Let's see if we get anywhere close to that. The banks start this afternoon, and we'll see how it carries for the next couple of weeks.
Yeah, and I also think that generative AI can help us out in efficiencies. It already is, and so that's affecting the bottom lines of the companies. And at the same time, a unwritten parallel right now. Let's talk about it a little bit, but consumer sentiment in the markets or confidence in the markets. You got new retail investors, right? You got current retail investors. They're pouring money into the market saying, this is our only way in order to build our current lives and our future lives by just tossing money in the market. I'm not getting that much wage growth at my job. Inflation is still so high in these services. How do I outpace this? So if AI can help companies with efficiencies and keep the stock market going up, and folks still have that confidence in the market, then we can continue this, bull run a little bit, just by efficiencies and confidence in the market.
All right, and we'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.